Chapter 10, Part 2. Now we're going to again do some more short-term decision tools we're going to use, and one would be used to determine whether we should eliminate a segment or a part of the business, keep or replace a piece of equipment, and then look at pricing using total cost versus variable costing. And then what happens if somebody comes to you and says, hey, one time only, I want to buy so many units, what's your best price? So again, relevant costs. We only want to look at incremental revenues and incremental costs and incremental income. We choose the alternative that most increases income. Now we're going to look at the last four of these: discontinued products or departments, keep or replace, total versus variable, and special orders. Now, evaluating a segment. Now, these are hard to do because sometimes if you have allocations, getting rid of a department may not necessarily mean that you're going to save as much money as you think. So, a segment is a candidate for elimination if its revenues are less than its avoidable fixed costs. Avoidable costs are amounts that can be eliminated when the segment is eliminated. Unavoidable costs are amounts that would remain even if the segment was eliminated. So, the question is, if lost revenues from the discontinuation of a product exceeds the cost savings from discontinuing, you do not discontinue. If the opposite is true, you discontinue. So let's take a look. This example is from your book, but I think it's a good one. All right, here we have an example. We have treadmill, which is obviously losing money, and right now they want to eliminate it, but as you can see, it's carrying $15,000 of the fixed $45,000 in fixed costs. So then the question becomes, how much of those fixed costs are going to go away? And if they do go away, they better exceed $10,000. Because otherwise you're going to lose money if you get rid of treadmill, because it's helping the revenues it's earned. The contribution margin is helping cover some of those fixed costs. But only $4,000 of the fixed costs are going to be avoidable, so $11,000 of the remaining fixed costs would have to be reallocated. And of course, the Wellness and Fitness Center would not be happy about that, because all of a sudden their costs are going to go up. And since $11,000 of the cost are not avoidable, then it's more than the $10,000 you're going to save. So now fixed costs are going to go down by $41,000, but the problem with that is that your net income is going to decrease. So the issue would be, maybe it's not such a good idea. Unless, now this is the part we don't cover when we do this. This is a quick way of doing it, but of course you have to look at other things too. For instance, do people buy treadmills because they also are associated with the wellness and fitness departments? Would that affect the sales if you did away with that division? Also, is there any crossover in sales? So you have to look at a lot of things before you would eliminate a segment, but this is just one quick tool to use. Now, evaluate to keep or replace. Now here usually you're talking about equipment. So you want to compare revenues and costs of keeping the old versus replacing it. Replace an asset if overall income increases. Keep the asset if overall income decreases with replacement. So let's take a look at our example. My company is considering replacing one of its old machines. The old machine has a book value of $45,000 and a remaining useful life of 5 years. The $45,000 book value is irrelevant. It can be sold for $52,000. That's relevant. Variable manufacturing costs are $36,000 per year for this old machine. Information on two alternative machines I show in the corner there. We have machine A, we can buy it for $115,000, and we have machine B, we can buy for $125,000. And all this equipment has 5-year life. So compute the income increase or decrease by replacing with machine A. So machine A, to keep it, if we replace it, we'd get $52,000 from selling the old machine. The cost, purchase the new machine, and then we have the variable costs. You take $36,000 times 5 years. Obviously, we're not using net present value on this. We take the $19,000 times 5 years. Again, also, we use that. We look at that in Chapter 11. Because you wouldn't just look at it unless interest is zero, you would never look at it this way. All right, so we look at the income loss, and according to this, if we went with machine A, we could improve our income by $22,000. Now let's look at equipment B. For equipment B, we go through the same process, and in this case, we could save $32,000. So based on this, we should replace the machine, but we should choose machine B because we save the most money. Now, what about determining product selling price? So, there are two ways that a price is set depending on the kind of product it is. If it's a price setter, you have more control over setting the price. A good example would be Apple phones. Let's face it, we do pay a lot if we get an Apple phone. Now, price setters use more cost plus pricing because they don't have to worry so much about competition. Price takers have less control over setting prices. Their product tends to be more vanilla. There's low barriers to entry. The product is not unique, and there's strong competition. Because of that, we have to use target pricing, and in that case, what we do is set the price and work backwards to reduce our cost because we know if we sell it, we can only get so much. So it's a different approach. So what about cost plus methods? So what we're going to do is we're going to take the total product cost, including all costs, determine it on a per unit basis. Then we're going to take it times the markup, and then that will tell us the selling price. So let's work through a problem. So in this case, it's cost, and they have 10,000 units they're producing. The target profit is 12.5%. The variable cost per unit are $100 for materials, $25 for direct, and variable overhead is $20, and variable selling and general administrative is $5. And then they have fixed overhead of $270 and fixed selling and G&A for $230. What is the total cost? So the first thing we do is add up all our variable costs, and then what we do is we take our fixed cost divided by the number of units we're going to produce, so we get an average cost per unit. As you know, we're not supposed to look at it like this, but we are for this example. And that tells us our total cost per unit. That's step one. Then we're going to take it times the 12.5%. That tells us the markup. And then we have our selling price of $225. Now, that's called absorption pricing, and that's when we have a price setter, we can do that. We just take all our costs and say, how much profit do we want? That's going to be our price. Now, the variable cost method, we do a little differently. First, we have to come up with our market percentage, which is going to be our targeted profit plus our total fixed cost divided by our total variable cost. That's going to give us our percentage markup. Then the markup per unit is going to be the variable cost per unit times the markup percentage. And then the selling price is going to be the variable cost per unit plus the markup. So let's work through that problem. So first, we're going to take our total variable cost times the number of units, and that tells us that our total variable costs are $1,005,000. Now, we're going to take our targeted profit of $200,000. That's it is in this example. It tells you up there. We now have a targeted profit of $200,000. Plus, we want to cover our fixed costs. And that gives us a markup of 46.7%. Now, what's our markup? It's going to be $70 because we take 150 times 0.467 gives us $70. And now we have our total selling price of $220. Now, targeted costing. We take our expected price, We back out our profit, and then that tells us how much we can spend because we're going to have to reduce costs to get it to that $66. It's a lot harder way to price. Now, what about special offers? When we have special orders, now what you have to remember, you have to be very, very careful about this when you're in business. It has to be a one-time only. It should not be from somebody you normally sell to, because once you do this with a particular customer, they're going to think you should do it all the time. So you have to have excess capacity. It has to be enough to cover your incremental costs. And will it affect overall sales in the long run? Because that's very important. So this is done you have to give this a lot of consideration before you do it. So, do we have excess capacity? If it's yes, we want to consider it. Now, Mike's company has a capacity of 70,000 units and currently produces 55,000 units. At current production, the selling price is $45, variables are $30, fixed are $4.10. They have been asked to fill a special order for 10,000 units at a special price of $25. Should they do it? I can tell you right now the answer is no, because you can't have it be below your variable costs, because you're going to lose $50,000 if you do that order. So they should not do it. Now, what if instead they're offered $40, but with an additional one-time special cost of $15,000? So we're going to take the sales less the variable expenses, gives us our contribution margin, times the number of units, less the special price. So we would get an increase in operating income of $85,000. So this would be a good deal because it improves operating expense. But again, you have to do this by exception, because if you sell for $40 to one person, they're always going to want it for $40. And that ends part 2 for Chapter 10.